Our mission at SD Bullion is clear: the lowest cost gold and silver available online. While we do not have pretty blue boxes, free shipping, 4% credit card fees, or glamorous gold and silver infomercials, SD Bullion has the lowest prices that may save you hundreds on your next order. So before you make your next investment, do the math and join the over 15,000 new customers who have recently made the switch to SD Bullion. Why pay more?
This is the Doc and Eric Dubin with the SD Weekly Metals and Markets Wrap. Joining us again today is one of our favorite guests, Alastair McLeod. Alastair, it's great to have you back on the show.
It's very nice to be back on the show, Doc. Thank you for asking me.
Well, we asked you in advance, as we anticipated we'd be seeing quite a bit of volatility in the markets, and that we have here the second half of this week on the heels of the long-anticipated Fed rate hike announced Wednesday afternoon. And we sure have been seeing quite a bit of volatility over the past 24 hours here. Gold and silver actually traded up on the day on Wednesday, but have just been hammered again with most of the commodities complex here on Thursday. Gold down about $30 at one point, traded below $12.50. Silver back below $14 level. So let's start off with the Fed rate hike and the markets here and get your take on it, Alastair.
Well, I think it's very important to be aware that global debt is the biggest problem facing the central banks. I think in some senses the central banks actually don't understand that it's a problem because we all just roll over debt. We're debt junkies, if you like, and it is, if you like, the new norm. Everybody looks to borrow more, to buy more, to borrow more, to buy bigger houses. And if you're a government, and total government debt around the world is in excess of $60 trillion equivalent, there are very few governments who expect to reduce the level of outstanding debt. And if anything, they expect to increase it, and they expect the purchasing power of their currencies to go down, so that effectively it's a transfer of wealth from savers to governments. Everybody's doing that. We've all turned borrowers. Now, the result is that the amount of outstanding debt is now so large that it takes a very small increase in the amount of interest charged on that debt to destabilize the whole financial system. And I think that's the risk that the Fed faces. Now, I don't suppose that 0.25% is going to make a huge amount of difference. But what it could do is it could increase the spreads, if you like, between US Treasuries and corporate debt, and particularly the low-grade corporate debt, junk bonds and that sort of thing. So a lot of zombie companies basically face bankruptcy. We don't seem to worry about that. We think that the problem in the junk bond market is a sort of market liquidity problem. And nobody actually seems to turn around and think, hold on a minute, the reason that we've got a problem in that market is basically because it's rubbish. And I think that we need to really sort of think this through. And to my mind, the big elephant in the room now is commodity-related debt. I mean, if you look at the largest part of the sort of industrial commodity market, we're talking about energy. Now, oil alone, the price has fallen from somewhere over $100 down to around about $34, $35 over the course of this year. The effect of that on the oil industry in total has been to reduce the oil industry's annualized income by roughly $2 trillion. Now, that $2 trillion is used not only to pay wages and all the rest of it, but is also a critical component in paying the interest on debt, which has been taken out to finance the extraction of oil. And, of course, the drop in taxes in countries like Saudi Arabia has really profound implications for OPEC members. And in the case of Saudi Arabia, it's a Sunni state. They've got Shias to the north. The Shias in Lebanon are actually managing to capture ground, and this doesn't get much publicity in the West, but this is a real problem for Saudi Arabia. Plus, the oil workers at the oil heads are Shia. So you've got a potential revolt there, and you could place, if you like, the responsibility for this back at the oil price. So there are all sorts of problems. Now, if you think about the total amount of debt in not only oil, but also in other extractive industries. I mean, Anglo-American have had to lay off 80,000 workers. Mm-hmm. We know that Glencore is going through another round of restructuring. These are the big guys. Think what it's like for the little guys. I mean, there is real disaster in financing the commodity extraction of all sorts. And the effect of that, I think, is that because it is mainly in dollars, because obviously the product is priced in dollars, it is, if you like, a problem that faces is faced by the U.S. banking system because it is dollars. The U.S. banks, I understand, have about 1.7 trillion of equity capital, assuming that's none of that is tied up, if you like, by other bad debts, which is a very optimistic assumption. Compare that with the potential loss, bankruptcies, and all the rest of it in the commodities game. You're looking at that 1.7 trillion being exceeded by a factor maybe 4 or 5 times. So, an increase in the spreads, an increase in interest rates, dollar interest rates, we're playing with fire here. And I think it is actually very, very dangerous. So that's my initial take on it anyway.
Earlier in the summer, we had an issue with reverse repos, and there were upwards of approximately $600 billion worth of reverse repo action by the Federal Reserve, probably associated with the currency swap as well, too, to be able to execute that kind of a massive move, because it was essentially justified and necessary to inject treasury collateral into the global markets, particularly in Europe. In reflecting on what happened yesterday with the Federal Reserve, and we're recording this on Thursday, one of the interesting things that they did was increase the amount of interest paid on balances at the Fed by 25 basis points to now 50 basis points, if memory serves. So, Bank of America, J.P. Morgan, et cetera, their reserves that they have at the New York Fed is actually earning them interest. And then on top of that, they also removed restrictions on the dollar magnitude of flexibility for using repos and reverse repos. And I'm wondering, we have this issue with all of this bad debt that's being generated in the commodity sector, and the pricing collapsing such that cash flow is no longer able to support this debt. And presumably we have derivative positions tied to all of these companies, particularly examples like Glencore and Deutsche Bank. What do you think is going on here as far as the powers, the masters of the universe at the central banks of the world, in terms of what they're trying to do to juggle all these plates, and in the process of interest rate normalization and raising the Fed funds by 25 basis points, with their goal of doing upwards of 100 basis points over the next year? I mean, it seems that they're trying to address this issue of treasury collateral and bad debts with this reverse repo change and the change in the interest paid on balances held at the Fed. Do you have any thoughts on this, Alastair, and what do you think might be going on? Because these definitely were the lesser of the headlines from yesterday's news, but I think they're actually the more significant.
Well, I think probably the best way to look at this is to try and look at it simplistically. The Fed has on its balance sheet something like 2.6 trillion of bank reserves, the vast majority of which is excess reserves over what would be required, if you like, as part of the fractional reserve banking system. But they don't separate it out anymore. Anyway, that's another issue. But if you've got excess reserves, I mean, historically, huge amounts of excess reserves, which are sitting there quite happy to take up to 1/4% interest, which is what the Fed funds rate pays, then if you raise interest rates, effectively what you're doing is you are encouraging banks to deposit on the margin even more excess reserves. So this, if you like, it is a deflationary move, raising interest rates from that point of view. What the Fed must have done is the Fed has seen that money supply has been increasing. And there's no doubt about it. People have been using low interest rates to acquire, sort of car loans. You've got credit cards. You've got mortgages. In other words, the asset inflation, which is so far being more or less confined to the financial markets, is beginning to leak out in terms of assets or financing assets which aren't central to Wall Street, such as property, but also leaking out into big ticket items like motor cars and so on and so forth. Now, I think that is actually what the Fed has got its eye on, and it's sort of thinking that we've got to manage the growth of money supply so that it doesn't take off and go out of control. So the judgment they have in effect taken is that 0.25% is allowing too much money to leak into the real economy in the form of bank credit and mortgages and so on and so forth. So if we increase it by a little bit, then that will at least stem the potential inflation from bank credit being applied to the wider economy. And so I think that's really what they're doing. When it comes to the reverse repo side, it is, I think, probably rather tied up with the lack of proper high-quality collateral in the markets. And this has been a real problem since the Fed and the ECB, for that matter, have more or less cornered the market in high-quality government debt. I mean, the ECB has also cornered the market in rubbish government debt as well, because I mean, if you if you buy a 2-year Italian government bond, you get a negative interest on it. I mean, it's markets are absolutely crazy. But I think through this, what I detect from the Fed's action is that they are trying to control the rate at which bank credit is expanding into the wider economy, the non-financial economy. And they have judged that to raise the Fed funds rate by 0.25% will put a brake, if you like, on the bank's tendencies to expand bank credit. So I think that's the way I'd look at it. Now, obviously, the Fed economists think that they've got control over the situation. They've always thought they've got control over the situation, even though events have often proved otherwise. And I think they're forecasting that if they can control this sort of expansion of credit, that allows them to get inflation up towards the 2% target, and it allows them to run things on a basis that it's never really going to go away from that 2% target. That is the hope, and that's, I think, behind the briefings, which have led a lot of the mainstream media to talk about the probably 4 interest rate rises in 2016, taking it up to sort of 1.25%, something like that. I mean, the number of times in my long life in the city that I've heard about central banks wanting to have a control process. I mean, if I had $1 for every time I read that somewhere, I would be quite a bit more wealthy than I am.
I mean, can you think of a single example where central bankers had an accurate forecast?
Yeah, well, yeah. So you can, please forgive my cynicism about the Fed's expectations on this, but I think that's broadly what they're doing. They're trying to run this little balancing act. But I think there are other problems which they're ignoring, because on the one hand you see falling commodity prices perhaps acting as a little bit of a stimulant to the non-financial economy in America. Particularly energy prices falling so dramatically. I mean, they're a third of what they were at the beginning of the year. I suspect that, just by concentrating on that aspect, the Fed is missing the larger aspect, and that is what is going on in the rest of the world. And the rest of the world is heading into a slump. Now,
even in the United States, I mean, if you net out all of the jobs that have been created since the crash of 2008, it's been all in the energy sector.
Yes.
I mean, yes, there's plus and minuses across the board in the entire economy, but on a net basis, the energy sector accounted for 100% of the job growth.
Oh, absolutely. And all these bad debts are certainly going to visit the U.S. banks, as I said earlier. Meanwhile, you've got sort of really indicators like the Baltic Dry Index hitting just lows. I mean, taking out the lows that we saw in 2009.
Yeah, all-time lows this week.
Yeah, yeah.
And it's not. It's containerized shipping. I mean, everywhere you look, every economic statistic that you care to look at, other than the employment report, which is significantly massaged in the United States and in other countries. We're in a significant recession that's already visible, just not declared.
Yeah, but the Fed is ignoring this, and I can see, given that there is a little bit of an expansion of money supply, broad money supply in the domestic market, I can see why they're ignoring it, because they reckon that's the biggest, the bigger priority. But you can't ignore what's going on in the rest of the world. I mean, it's not good, and I think that China is in a position where it's actually exploiting this pretty well, because what so many analysts do not understand is that the Chinese economy, in terms of trade, is so much larger than the US economy. And what that means in practical sense is that when China moves the yuan peg down against the dollar, it's not actually devaluing the yuan. What it's doing is it's revaluing the dollar. It's pushing the dollar up as far as all its trading partners are concerned. And you see that with the effect on commodity prices. Now, China doesn't want to be a patsy that sort of takes losses as a depositor, if you like, in dollars, and as an owner of US treasuries. It doesn't want to, sort of, if you like, suffer the wealth transfer of declining dollars measured in yuan. They would rather push it the other way around, and that's what they've done. And another factor, of course, in this is that by encouraging a strong dollar, which is really what the dollar revaluation is, they're driving down commodity prices, and guess what? They are the largest buyers of commodities in the world. So for China, there's actually another agenda which makes it very difficult for the Fed to retain any sort of control over the economy through monetary means. And I just think that the control of the US economy is probably as much in China's hands as it is in the Fed's hands, if not probably more so in China's hands. Now, that's quite an interesting thought, because where does that leave the Fed? It leaves the Fed actually not in control of anything significant. The only thing it can do is rescue the banks when they go bust by printing money, or by writing open-ended checks, which is what they did with the Lehman crisis.
Well, it's definitely interesting to see China continuing to devalue the renminbi vis-a-vis the dollar and other currencies in the last month or so, since they gained a 10+% share in the SDR basket. So,
yeah,
they're definitely flexing their muscles.
I would very strongly emphasize that the way we've got to look at this is it's not the yuan being devalued, it's China revaluing the dollar upwards. And you can call it geostrategy or whatever you like, but it just suits China to do that. It doesn't have any inflation effect on China's domestic economy. I mean, the idea that if you devalue your currency, you're going to have an inflationary effect down the line, that is normally true. But in this case, because China is the bigger economy, and certainly, that's on a PPP basis, by the way, and certainly far bigger than the United States in terms of international trade, actually what she's doing is she's increasing the value of her reserves, which she will then spend on artificially cheapened commodities. And we know that she's been doing that. And there is another aspect too. By pushing these policies, what China is actually doing is it's sending a very strong signal to any international trader who finances himself out of dollars to run his international operations, that actually he shouldn't think in terms of funding in the reserve currency, he should be matching his funding with where he's sending his exports, whether it's raw materials or semi-manufactured products or whatever. In other words, this, if you like, is a real dig at the United States hegemonic status that it's trying to keep for the dollar. So it really does fit in with China's overall strategy of becoming not the reserve currency for the world, but certainly the most important currency in Asia, and probably the most important currency when it comes to international trade.
China recently announced that they were going to formally launch the Shanghai Gold Exchange's settlement in April. I think it was April, not March, next year. Initially, they were talking about doing that in this December, but for a variety of reasons, they had to delay. I'm kind of curious what you think as far as China's effort to set the price establishment in the futures markets, and it'll be a physically based trade system as opposed to what we see on the comics and LBMA.
I think I think there are two things I would say about that. I think the first is that it is very important, as far as China is concerned, to price key commodities and money and things like that in her own currency to increase the liquidity of her own currency. And the second thing is that I think it just shows how important she thinks gold is. Because I think the only commodities that she's really thinking of doing this is commodities and is gold and possibly oil. So you can see that, yes, gold is extremely important to China. I mean, what we don't know is exactly how she's going to tie in gold in terms of Asian settlements, and whether she will use gold as a component, if you like, to add stability to her own currency. I think that's quite possible, by the way.
Yeah, or maybe issuance of gold-backed bonds, or some kind of a hybrid, middle-of-the-road strategy. I can easily see them doing.
On the subject of Asian gold, one thing that's interesting is the situation in India. The head of the Reserve Bank of India was effectively, he was an IMF economist back in, I think, 2003 to 2006. And he's very much the establishment man who, in my view, was put in by the West with a mission to control Indian demand for gold. We're talking about public demand for gold. Now, since then, what's happened is that the Reserve Bank of India put in regulations to try and restrict the flows, and the predictable happened. Smuggling took off, and they had to rescind the bulk of those regulations. Now they're going on a plan B. They're trying to get people to deposit gold with the government through the banks, get paid out as if as if it was gold, on the basis that when it comes to redeeming their gold bond, they would be paid in rupees, the equivalent price of gold at the time. And what this looks to me like is a scheme by the Indians to replace a failed plan with another plan to reduce the demand for gold on the international markets. And there is now a second element, and that is because she has an impending membership of the Shanghai Cooperation Organization, she needs to boost her own government gold reserves. And she wants her citizens' gold in order to do that. As Americans, does this ring a bell with you, perhaps?
Yeah. And you wrote an interesting article about that last week and suggested that there might, in fact, be some kind of confiscation. In the 30s, it was estimated maybe only upwards of half or so of the gold that were held in safety deposit boxes and individuals under mattresses or what have you was actually returned. A good chunk of it actually floated to Europe. What was it, 4 400 grams or some ridiculous number in the first month or so that they were able to successfully, quote unquote, pull in through this program.
Yes, it was 400 grams in the first 2 weeks.
Yeah.
It's absolutely derisory.
I mean, when you think the temples are one thing, because that's a small set of people managing a very large stockpile in individual temple examples. But when you think about what happened in the 1930s versus what could easily be imagined for India, the comparisons are so different just because the average peasantry doesn't own that much gold. Whatever bangles or what have you may be around someone's neck, a wife's neck, but it's not as readily accessible. So I don't even think that even if the Indian government wanted to execute something other than the possibility of shaking down temples, that they wouldn't be able to succeed even if they wanted to try to do it at the point of a gun.
Well, I would rule out any attempt to, if you like, confiscate gold from the temples, because if you're talking about mucking around with people's religions, you've got riots in your hands. It's as simple as that.
Yeah.
So, I think the people who run the temples, where they have been quoted, they have been sort of evasive on the subject, because there is absolutely no point in sort of stirring up sort of anti-government antipathy. There's no point at all in rocking the boat. You say, well, we will consider it, and of course you won't consider it, sort of thing. So I actually don't think that the Indians can possibly go down the Roosevelt route without enormous social unrest. I mean, I think it really would be because you don't have what I would have imagined was the if you like, the sort of the patriotic fervor which Americans, in my experience, have certainly, I think, still got, but must have had in large quantities back in the 1930s. I mean, I think my impression of Americans, and tell me if I'm wrong on this, but if back in the 30s, if the government said do something because it's patriotic, people would do it.
Oh yeah, absolutely. And it's not even just patriotism, just generic trust in government institutions and institutions of society overall.
Yeah,
were much higher back then. I mean, now we have the congressional approval rating fell as low as 6% last year.
Yeah. Well, absolutely.
That's pretty bad.
But this does not exist in India. It really does not exist in India. So I think government attempts to get gold out of people, I think, will fall flat on its face. Incidentally, they roped the World Gold Council into a coin issue, which was part of the package, as it were. But the coin issue, when you actually look at it, initially they're only minting 4 kilograms of gold. And you sort of think, well, yeah, okay, 4 kilograms of gold. That's spreading very thin amongst 1.25 billion people.
And you're thinking the machinery costs for that.
Well, it's not that. What it's done, and I tell you, I think if I was, funding the World Gold Council, I think what it's done is it's roped the World Gold Council in to a government scheme which actually, at the end of the day, is anti-public ownership of gold. And I think that is entirely wrong, and I think that they should really have not got involved in the first place.
Yeah, our lovely trade organization that does such good work.
Well, yeah, I mean, no comment.
Yeah. So what's going on in the physical front, John? We've been blabbing too much.
I've been sitting back and enjoying listening to Alastair as always. Well, what we've seen in the physical front here, the U.S. Mint called it a year this week here on Silver Eagles at an even 47 million ounces. It's up about just under 7% from the previous record, about 44 million. They're likely off at their cocktail parties this weekend, patting themselves on the back for a great year of record sales and production, guys.
I think what's interesting is you've got two elements of government here. I think the guys who are actually in that, working in the mint and doing that, I think, yes, that you're right. They would be patting themselves on the back for a job well done. However, I think that there are certain elements, perhaps in the Fed or in the US Treasury, saying, damn it.
Yeah, it'll be interesting once the first couple of allocations of the 2016 Eagles come out. We may have a new monthly sales record. I think you're going to be looking at 6 to 7 million coins sold in January if the mint can produce that many. So it'll be interesting. Across the entire market, premiums are a bit elevated. Supplies are tight, but they're not. The vaults aren't all dry like we saw back in the September timeframe. Now, certainly, things can change quickly with this being the last week of Silver Eagle sales. Similarly to what we've seen in the Gold Eagles, the U.S. Mint abruptly halted Gold Eagle sales about 2 weeks ago now, and the entire market is completely dry of Gold Eagles now. Even backdated coins are selling on the wholesale market now for around 5% over spot, where typically they sell under 3%, and you can get new coins. The U.S. Mint sells new coins at 3% over spot to their authorized purchasers. So we've seen about a 2.5% jump in Gold Eagles, and I mean, most of the largest U.S. wholesalers and distributors, I mean, they're down to a handful of Gold Eagle coins, and they're looking at probably a month to go, and there's simply no Gold Eagles on the market to be found anywhere in the number one gold coin in the country. So right now, gold's actually a bit tighter than silver, just simply due to the fact that the U.S. Mint has called it a year a couple of weeks early on Gold Eagles, and very abruptly at that. It wouldn't be surprising if the same situation does not manifest itself in silver, given a week, 10 days. Because, I mean, nobody was short Gold Eagles before that. The authorized purchasers have been able to purchase as many as they wanted until that abrupt announcement. With the Silver Eagles, obviously they've been on allocation since July, so none of the authorized purchasers have been able to stack up a big hoard to weather the next 4 to 6 weeks. So it'll be interesting, particularly if silver prices stay at a 13 handle or potentially head lower. If you see a 12 handle, you'll likely see the type of supply issues we saw in Q3. So it'll be an interesting 4 to 6 weeks. Once the market sells out of the Silver Eagle coins, that's when I would expect to start rapidly spreading to the other generic mints and other government mint products.
I think around the world there is good demand for coins because people who buy coins actually go for value. You know, they're not trend chasers at all. And the trend chasers, of course, are in the paper markets. And by literally printing contracts, you can control the price in the short term as much as you like. But of course, at some stage, this physical runs out. And I think because we're seeing persistent backwardations in the physical markets like London, it's been going on for some considerable time. And I think that must be coming to an end very, very soon. But the price of gold, I think, is rather tied up with all the other distortions we have in the markets. I'm not going to turn around and say that it's manipulated or anything like that. Of course, it is manipulated. But in terms of other markets, I mean, you've got equities, which are wildly overvalued on any basis. They're valued, if you like, on the basis of very, very low bond yields. The bond yields are far too low. Even if the Fed is right and they can gradually raise interest rates over the course of 2016, then that makes equities expensive. It makes bonds expensive and therefore equities expensive. But I see so many of these markets at sort of bubble extremes. I mean, the dollar is at a bubble extreme itself. And at some stage, that's going to reverse. And when that reverses, it'll probably reverse very, very quickly. So I can see everything maybe snapping at the same time. And I can't emphasize strongly enough that I think the thing that will probably do it, beyond maybe the initial move, is likely to be the emergence of real global debt problems. And if there is the canary in the coal mine, I think it's probably in the commodity space.
Fear of solvency issues. We haven't had that in the credit markets in an earnest form, other than like blips here and there with Greece and so forth, going all the way back to 2008. I mean, we haven't seen it since then. It's coming. I think that's going to definitely put a bid under gold. It's interesting, too, because, most people think the mantra, conventional wisdom about rising interest rates being bad for gold and silver is being just a truism, and it isn't. In fact, historically, more often than not, rising interest rates as a paradigm have occurred when precious metals were rising. And we'll include a chart that goes over some 50-odd years of history, and we can see that in terms of Fed funds rate, interest rate cycle, normalization efforts in the precious metal space. But when you mix that combined with what's going on in the physical market, I mean, China, roughly about half of their gold mining operations are not profitable with gold under $1,000. And the persistent backwardation that you state, the halving of the ETF vaults, and on and on. I mean, the central bank leasing and all of the various signs that we have that there's far less freely available gold in central bank hoards, and all of the raiding of all the above ground hoards throughout the 2013 period in particular, up until today. I mean, all of this points in the direction of gold and silver trying to bottom. But, when we're in a 4+ year bear market cycle, everyone and their dog hates it when we say these things because sentiment is so terrible. But maybe it's possible that the cartel can push their luck and get prices, $800 gold, $8-9 silver, who knows? Maybe, but on the flip side of that, they could remove 50% of the forward production in the next 3 years.
Yeah. Well, if they get it down there, I'll be delighted to add to my positions, I can assure you.
Yeah.
If it goes down there, Alastair, you'll be delighted to add to your paper positions.
Well, yeah, I mean, I was speaking at a lunch the other day, and the host asked us all, what our trade for 2016 would be. And a lot of these guys, I mean, they were investment managers of different sorts and economists, and they came up with sort of fairly normal stuff. I'd buy this market or I'd buy that market. Well, I reckon that the best money-making opportunity for 2016 will be to short the dollar by buying silver. So that's my tip for 2016.
Yep, that sounds like a trade that would be really hard to lose money on, but you never know.
Well, I mean, you might lose money if you like, in the first sort of month or two before it gets going. But once it gets going, I really do think that you've got something that could well triple easily in 2016.
Yeah.
Really, because everything is heading towards some sort of economic dislocation, the thing that's interesting about this debt problem is that could it be that the strength that we're seeing in the dollar is because people who owe their banks money in dollars are having to cover forward in order to have the dollars to pay the interest, pay the banks, whatever. So they're all scrambling for dollars, being short of dollars. Once the thing snaps, that is going to go completely. And it'll probably go with a few banks as well. And under those circumstances, of course, the Fed will open its checkbook and say, how much? It's as simple as that. And this time, I think the effect is going to be in the currency. And that is why I think the trade of 2016 is short the dollar by buying silver.
Yeah, and timing will definitely be interesting. I mean, right now we're seeing the idea of the dollar index going over 100. Earlier in the week, we saw a dive, but it's now bounced back, and it will probably going to be seeing some pressure in precious metals periodically because of that. But you just have to assume that at some point the economy is going to force the Fed's hand and make them back off. But in the near term, I think that there's also a risk of a lot of people talking about the one-and-done thesis and believing that that's where the Fed's going to be. And frankly, I think that the Fed, once they decide to be obstinate and move in a direction, they're very good at maintaining that direction until something truly breaks rather magnificently.
Yeah.
That's the history of what the Fed has done. In fact, all central bankers for the most part. And I think that's what we're probably going to see sometime, 2016. That the people, Jim Cramer was famous for screaming about the federal discount window needing to be opened when we were having all the trouble with Bear Stearns and other hedge funds and maiden lane products with the Alt-A market and so forth. And I think we're going to probably see him do those kind of things in 2016. Screaming for the Fed to back off, etc.
I'm sure you're right. But I think the problem with all government officials, and whether they're sort of slightly at arm's length in the Fed as opposed to directly employed by government, is they're never wrong until they are wrong.
And then they don't even admit it then.
Well, that's right.
They scapegoat.
Yes. Yeah, it's nasty speculators or whatever.
Gold hoarders, stackers.
Yeah, absolutely, yes. That's right. That's unpatriotic.
Well, Alastair, I don't think you'll get any arguments from Mir Eric about your trade for 2016. It certainly would be about time.
Well, I hope it'll make money this time. It wasn't very good in 2015. But there have been worse trades, in my defense. I was looking at it, actually, and the price of silver over the year has fallen by, I think at current prices, it's something like 11%. Which is not nice, but could be a damn sight worse.
All right. Well, certainly be interesting as the Fed attempts to hike rates a few more times in 2016, whether they're able to, and the impact we'll see on the markets and gold and silver in particular. So, Alastair, is as always, great to have you back in the show.
Nice to be back.
All right. Well, we'll wrap this week's show there. So for the Doc, Eric Dubin, and Alastair McLeod, thanks for tuning into this week's SD Weekly Metals and Markets.